Michael Carnevale is branch manager and financial advisor. Securities offered through Raymond James Financial Services Incorporated, 400 Southbridge Street in Auburn, Massachusetts, 1-800-657-9126. A member of FINRA SIPC and are not deposits, not insured by FDIC or any governmental agency, not guaranteed by Webster 5 Cent Savings Bank, and subject to risk, may lose value. Webster 5 Cent Savings Bank is not affiliated with Raymond James Financial Services Incorporated. The information contained in this report does not purport to be a complete description of the securities markets or developments referred to in the material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Any information is not a complete summary or statement of all available data necessary for making an investment decision and does not constitute a recommendation. Any opinions are those of Michael Carnevale and not necessarily those of RJFS or Raymond James. Expressions of opinion are as of this date and are subject to change without notice.
Good afternoon, ladies and gentlemen, and welcome to the Long Hill Report. I'm Richard Morchoe, and today we have Mike Carnevale, who is Raymond James, and he's going to speak again about where we stand in the economy, and we've transited to November, and the Dow closed for the month at an all-time high.
It did.
It did, and I'm sure Michael is happy about that, and people who know him are happy about that.
After September's big drop, which, historically we know September is the worst month of the year. No surprise there. October is generally a little better, and right on cue, it happened. As you had just mentioned, the Dow closed at an all-time high. For the month, it was up 5.8%, and for this year, 2021, the Dow's up 17%.
That's big.
And if you think about all the things that have happened since January 1, how many people would have said, oh yeah, the market's going to be up 17%?
It is a little bit of a surprise because even before the end of October, we heard the world was in trouble because of all those ships piled up at the ports. How does that happen? That we've got this kind of debacle in a way, but yet the stock market is booming.
Yeah. Well, the stock market, there are lagging economic indicators and leading economic indicators. So the stock market is a leading economic indicator. So it's looking at the future, and it's making a decision today what they think will happen in the future. So all these ports are all backed up. There's a lot of lead time on trying to get anything done because there aren't enough people working because of the COVID situation. Gas prices are at all-time highs or 7-year highs, but the market is convinced that all this is temporary. And that's why prices are going up. Because if you thought the future was bleak, you would not be bidding something up. You'd be doing the exact opposite.
That's certainly true. Why are people going in with that optimism? Do you have an opinion on that?
Well, I think there's a couple of things. One is what's actually happening. Interest rates are so low. You got to do something with the money that you have. So there's no competition right now. If interest rates were a lot higher, there'd be competition. Yeah, I was in the stock market, but gee, I can get a 5% CD or bond, so I'm going to get out of the stock market and go there. There's just no competition right now. So in the absence of competition, it's all going to one area. The other thing has to do a lot with, an intangible, like a believability. When I say people, I mean, it really isn't you and I who ultimately determine things. It's really the big institutions, right? Do they believe what the Federal Reserve is doing? So far, they believe it. And it has less to do with politics. It has less to do with who's the president or who's in Congress or who's at the State House. It's more, okay, the people that are controlling the economy, or the money supply, which is the Federal Reserve, do the big decision makers, do they have confidence in them? And they do. And that's why they're willing to say, hey, yeah, it's, we'll look at a lot of economic stuff. Yeah, it doesn't look that great, but they say it's temporary. We believe them.
Do they think Powell and company, you're saying they think Powell and company are doing a good job?
They do.
Are doing at least an acceptable job?
Yeah, I would say that they think they're doing a almost excellent job.
Excellent job. You also mentioned, we were discussing before, that Powell may not be reappointed. Now, if the market has confidence in him,
Right.
and Mr. Biden is suffering a few problems now,
Right.
wouldn't that be not the best thing to do?
It
And
wouldn't.
I'm being kind in the way I'm phrasing that.
Yes, wouldn't be. You're correct. Powell's term ends in February, and he's got to get renominated for 4 more years. So there's a poll out there. It's called the Predicted poll, which is run by, surprisingly, the University of Wellington in New Zealand. And they track this, day by day. His odds of getting renominated are dropping. They had been in the 70% area. They're now under 60%. But it's really become a political thing. And of course, Biden's trying to get this big infrastructure bill passed, and was it Build Bigger America or something?
Build back better.
Okay.
We all have slogans.
Yes. And so, as with everything, there's opposition, right? You got the conservatives, the center, and the liberal side, right? What does he have to give the opposition to get his plan? And the fear would be, at least my opinion, is the fear he would give them Powell. He would say, okay, we're gonna pick a candidate that the far left likes in exchange for you guys voting for my plan. That's the fear that could happen. Now, it's not great because it's still, even though his chances have really dropped, it's still like, 58, 59% chance he's going to get renominated. It did drop this week when Biden was over in Europe and they asked him and he said, we're close to making a decision. Some people interpreted that in a way it's going to be a change.
It kind of sounds a little like that.
Yeah.
So there is a thing he could do, and that is find somebody they liked even better that doesn't offend Liz Warren and
Right.
some people in the squad or whatever.
Right.
How feasible that is.
Right.
He just nominated for the control of the currency. Mm-hmm. The woman who's born in, I guess she's of Central Asian extraction, but she was born in the Soviet Union.
Okay.
And she is, for all intents and purposes, she's gone before the Congress and basically said, she hasn't said she's a communist, but basically said communist things, Marxist things. Now that is wouldn't sound to me like a market enhancing
No, it
strategy.
wouldn't.
No.
The question, of course, is she going to get?
She's not going probably. She might get approved for control of the currency,
Yeah.
but no, he's not going. If he were calling her up for the Fed,
Right.
that would be basically saying, I'm the Titanic and I'm looking for the iceberg.
Right.
So that's not going to happen.
Right.
Is there anybody he could?
Well, Powell, according to polls, would sail through renomination. There's a woman who's sort of second in charge now, Brainerd, who is much more liberal, meaning more anti-Wall Street. Her odds are down around 20%, but she would be the only one that is even close to being realistically considered according to the polls. And, you know, there's some concern that if he needs those ultra-liberal members to get his spending bills, that he would do something like that. That, I think, would be a negative. You know, you say what you want. Powell's done a good job. I mean, and we're talking more strictly stock market, strictly
Yeah.
no talk about, well, is he good for society or whatnot. Don't want to say you don't care about that, but that's not the focus. I mean, we could have had a real disaster in 2020 with the COVID situation. The Federal Reserve guided it through. You can say good or bad, but
We're still standing.
yeah, your investments, your 401k, your savings probably are at all-time highs.
I don't know how they did it, but
They did
I
it.
mean, 30,000. You remember that book about Glassman, I think it was, the $30,000?
Yes. Yeah.
Some people like that at that point, but a lot of people, yeah, we'll see, we'll believe it when we see
Yeah.
it. You see it.
Yeah.
It's here.
Yeah.
So,
So I think, you know, I think I find, you know, a lot of people are looking for certitude, and none of this has any of that. This is all, well, based on previous scenarios. This is what you could expect to happen. And that's the thing, to be able to, the whole key about investments or investing is controlling emotions and not being surprised. And I usually say to people, if somebody said it was going to snow in January, you wouldn't be surprised.
no.
If somebody said it's going to snow in July, you'd be very surprised. You'd be worried.
Yeah.
Something went wrong. And that's what all these indicators and, you know, like gauges on a car, really. I mean, they're giving a reading of where things are and where they are expected to go. So if it happens, you're not, you know, you're not surprised.
And you do have, as a lot of, below the, well, you have the technicals. You got the volatility
Right.
index now at 16 versus 23 a month ago.
Right. That's a negative. Lower volatility it means translates to less concern or less fear. So when are people less worried? When prices are high, when their stock prices are high. So you want to see that number going up rather than going down.
And
It's going,
going
down.
down. Well,
Yeah. I mean, it has been historically low for a while, but now it's getting toward like all-time lows.
so that would portend not a big upward swing in prices, to say the least.
Correct. Would be one of the indicators that would say, well, maybe things are not going to continue as they have been. The other indicator is the New York Stock Exchange 200-day moving average. That's just a percentage of the stocks that are listed on the New York Stock Exchange that are above their average price over the past year. So it was at 60% a month ago, and it's still at 60%. So that's generally anything between 40 and 70% is sort of average. So there's really no real concern there. The one that's really the concern is the oscillator. That is a formula that relates price to support and resistance levels, price to low points and price to high points. That has really gone up dramatically. A month ago it was at 41%. Today it's 92%. So to put that in perspective, The worst possible reading you could get is 100.
So that's not good.
That's not good.
Not
That
good.
shows that prices have really moved up fast in the short period. So what can happen if something moves up really fast quickly? It can stop moving up really fast, right? And go down. So that's a warning sign that, you know, hey, October was great. The Dow was up almost 6%. There are some signs, technical signs anyways, that say that may not continue. And so if it doesn't continue, right, doesn't mean you sell everything, and it doesn't mean you're shocked, because you think back and say, oh yeah, those indicators kind of were warning that we might be taking a break here. And that's all those indicators do.
Year end, we're coming up to that. Is that usually a kind of profit-taking time?
Not necessarily. Actually, we're entering the November 1, we're entering the most wonderful time of the year. There's an old saying, sell in May, go away, come back on Halloween Day. The period between May 1st and Halloween, historically, has produced just 4% of all stock market gains. From November 1 to April, I don't know, it's April 30 or 31 days, well, to the end of April, 96% of all stock market gains in history occurred between that period. So we're entering a great period. So we got the old sell in May, go away, come back Halloween. That's followed up by the Santa Claus rally, which is the last 5 trading days of the year, and the first 2 trading days of a new year. That's historically very positive. The months actually, September is the worst month. So it's funny, people would say, oh, you know, I think it looks bad, I'm gonna get out. Well, yeah, you might be right, but historically, October's better, November's a better month, and December's a better month. So you're entering into a pretty good period, historically. Now, the world could come to an end tomorrow, and you'll say, well, but you said it was gonna, but these are just indicators.
Yeah, it's an indicator, not a law.
Correct.
I got it. All right.
Correct.
So, I have to we all have to make the decision. Do we sell the family jewels and silverware
Correct.
and go long now?
Correct.
Okay. Well,
Everybody's got, I mean, just because the stock market's going to keep going up doesn't mean you should still be in it. Right? Some people have a goal, you know, if I get to X amount of money, I don't care what else happens, I'm happy with that. And that's the right decision for the individual.
so some of these indicators, other indicators, like are interesting facts.
Yep.
Wealth, top 10% own 89% of all stocks.
Right.
So what does that leave us little people?
Well, what it tells you, there was a study that came out in October that basically said the top 10% of people own like 90% of the stocks. And during this recovery out of pandemic, the top 1% of people saw their net worth gain by $6.5 trillion.
I had heard that, yeah.
Whereas the bottom 90%, it's a massive amount of people, right? They just gained collectively 1.2 trillion. So that tells you the gap between the people who are doing good and the people who are not doing good is getting wider. Generally, that's not good.
That is for our society.
Right.
Truly, that's not good.
And that's exactly what's happened.
There was a billionaire, or maybe even trillionaire, hedge fund guy. He's from Washington.
Mm-hmm.
Hanauer, I think his name is.
Okay.
He said, my fellow billionaires, if we don't do something, the pitchforks are coming out for us.
Sure.
Yeah.
Yeah. I mean, the gap is getting as wide as it's ever been. And that's, again, generally not a good sign for society in general, which then would not be a good sign for the economy, which would mean wouldn't be a good sign for the stock market.
Well, as part of the reaction to that, the rise in wages. Because often, they say, like, when the little guy gets it back, gets the wages, you can tell things are going differently. Like, there's even a lot of labor activity where there hadn't been for quite a while.
Mm-hmm.
So, but how do they get from 6.5 trillion to 1.2 trillion? How do we get this a little more even?
Well, what's really causing this is executive pay versus workers' pay, and executive stock options and incentives. When you look at, if you ever look at an annual report, a proxy statement on a company you may own, you'll see how the CEO, the treasurer, they're getting paid, right? He's getting paid $200,000 a year. And then in the next column, he's got stock options for the year of $5 million. So his total compensation is $5.2 million. And as the stock prices go up, obviously they're doing very well. Whereas the person on the line who's making an hourly wage or a salary can't tap into that. And that's what's really happened to explode this gap.
Occasionally, to write that a little bit, we hear the term, there's been a correction.
Right.
Okay, that's a big correction if you're going to
it's never going to correct that level.
Yeah.
There can be steps to cap executive pay or stuff. Whether that can get any votes or not, who knows? But that's really the reason for the cause.
The leading economic indicators you have, you reported to us, September up 0.2%, 17th straight monthly increase.
Correct.
Of the 10 components.
Right.
6 of the 10 are positive.
Mm-hmm.
Negative was consumer expectations, which is a chunk of the index, 14%.
Yeah, one of the bigger pieces of it.
And manufacturing work week, even bigger, 28%.
Yep.
That's negative.
Mm-hmm.
Do you think that is predicting or tending towards getting to the prediction of the next recession?
Downturn? Not yet. I mean, although the leading economic indicators have gone up for 17 straight months, the rate of increase is actually going down. And a lot of people say, well, it feels like we're in a recession. Well, the economic indicator that tells us whether we're in a recession is the leading economic indicators. A recession begins after 3 negative monthly.
Right.
We haven't even had one yet.
Yeah, you're right. Exactly.
So what does that tell you? It tells you the economy is still growing, but at a slower and slower pace.
Well, someone or some group of people in the powers that be decide we got to do something to keep the ball in the air?
Well, they're doing it now by keeping interest rates low.
Can that work forever?
No, I don't think it can work forever. I mean, eventually, and some of it is in economics. Some of it, you got to really get a handle on the COVID situation. You got to really battle going between vaccinated and non-vaccinated, and whichever side you're on doesn't matter. But it's friction that gets rippled through the economy, and so that's really got to be solved first. And I think this is one of the reasons why we went from a lockdown a year ago to big growth recovery. Now the growth, as we've seen with the leading indicators, is slowly slipping away. Now September we're up 0.2. I mean, we're close for it to going negative. Then you do have to worry. And so people are saying, well, I want my savings account rate to go, my CD rate to go up higher. Well, if economic indicators are weakening, the Fed cannot raise rates because that'll just weaken, that'll slow things down even more. So what did they say in their last meeting? Yeah, we may not raise rates till sometime in the second half of next year. And that all ties back to why the stock market's doing well. There's no alternative to go to.
Right, yeah, if the rates are that low, yeah, you're stuck.
You're stuck.
Good luck to them. I certainly hope they can keep the ball in the air.
Well, the question is, will they be able to?
Yeah.
You know, I mean, economic indicators, whether it's jobless claims, the employment, inflation, you know, they're all still looking good. Inflation is high, but the Fed keeps saying it's not a long-term problem. Now, do you believe it or not?
Well,
The stock market believes it, and the bond market also believes it. Because interest rates, if you took a look at the 30-year Treasury bond, right? So the rate on the Treasury yield moves in the opposite direction of Treasury prices move in the opposite direction of interest rates. So if you see inflation that's high, the Fed says, "No, don't worry about it. It's just temporary." Do you believe it? Well, one way to see if people believe it is look at the 30-year Treasury. If people don't believe it, the 30-year Treasury yield is going to go up. What happened last month? It went down. September it was 2.09%, ended in October at 1.97. So people, institutions really, yeah, they're believing what the Fed is saying. Because if they weren't, they'd be bidding interest rates up. Because they'd be saying, hey, wait a minute, the government wants to sell me a bond at 1.97%. Interest rates are going sky high. I need a higher rate. Instead, they gave them a lower rate, and they took it. So that tells you that, at least as of today, they're believing, yeah, this inflation thing is temporary.
now,
Time will tell.
who are the people driving this? I mean, is it,
Oh, it's institutions,
It's
it's
institutions.
endowments, it's insurance
but not Main
companies.
Street?
No, it's not you or I.
I know because I couldn't remember when I went down and bought, the Treasury.
Right.
I was
Right.
racking
It's
my brain.
institutions.
Yeah.
It's also foreign governments. I mean, it's China, really.
Which
China
is
the
the
biggest.
discussion we've had, I think, last month.
Right.
Where we're sailing more ships around Taiwan.
Right.
As a country we recognize as China's, but and
Right.
Blinken said, "Hey, you guys should join the UN,"
Yeah.
and we're counting on them to buy our bonds.
Yeah.
Okay, and you have made the point, eloquently, I'll say, that they've no choice.
They have no choice.
You feel that? You still believe that?
Yes, they have no choice. Number one, we're the biggest, most liquid bond market in the world. They can buy and sell at a moment's notice. They really can't do it as efficiently anyplace else. Secondly, and I say this kind of jokingly, who's going to buy all their junk? The U.S. is the biggest market for all Chinese products.
Is there anything they make we absolutely need?
Oh, I think people would say yes. I need the cheap TV. I need the lower priced clothing. I need the,
You do know that they, right now, there's a lot of Asian places that can do that.
Right.
But I'm basically not talking about the cheap consumer stuff.
Right.
Is there an indispensable aspect
the size of their workforce. So someone could say, yeah, it can go to Thailand, it can go to here. Yeah, but it's a fraction of the Chinese labor market.
You feel we have to take it?
They have to take it. They have to take
Do we have to take their, as you said, junk?
yeah, because the consumer won't buy a European product because it's too expensive.
So we're sort of like stuck in a dance of death.
Yeah. I mean, people say, oh, 73 cents for the market crashed, 80 cents crashed. The world is, I think, much more intertwined now. Yeah, China's doing a lot of awful things. They need us more than we need them. You know. Good. So what are they? So the Chinese are buying U.S. Treasuries. They're the biggest buyer. So what are they going to do? Buy United Kingdom bonds? Good luck. The market isn't big enough to handle them, nor is it as liquid. And so it's an interdependence. So the politicians will, I think anyways, talk back and forth. But again, it's the politicians. They don't control the economy.
World War I started in the most intertwined world there ever was.
Mm-hmm.
The networks of interdependency were vast in Europe, and they committed suicide with the stupidest war probably that has ever happened. I hope you are right.
Hopefully we learn something.
I am Mike Carnevale's biggest fan. And I not only hope, I pray that you are right.
Sure. Yeah, I agree.
Well, ladies and gentlemen, it's been an informative half hour, and I want to thank Mike for coming again.
No problem.